Hey everyone, welcome back to the channel. Today we're talking about a classic but very powerful investing strategy, and that is dividend investing. Why pick stocks that pay dividends instead of just chasing growth? The truth is, dividends bring a lot of value, sometimes more than people realize. In this video, I'll walk you through key reasons and data points that make dividend investing worth serious consideration. If you like content like this, make sure to subscribe. Let's dive in. First, a quick definition. Dividend investing means buying shares in companies that regularly pay out a part of their profits to shareholders via dividends, typically cash and often quarterly. But what really matters is total return, not just the price of the stock. Total return equals price appreciation plus dividends and dividend reinvestment. If you ignore dividends, you miss a huge chunk of what shareholders actually earn over time. That's why many analysts focus on total return rather than just the price growth. Here's something many people don't realize. Dividends have historically contributed a massive portion of stock market returns. For the S&P 500, which you know I love, studies show that dividends have contributed about 31% of total return, while price appreciation contributed the remaining 69%. Another long-range study shows that around 85% of cumulative total return from the S&P 500 with reinvested dividends came from dividends and compounding. Or consider this study. From March 31st, 1994 to March 31st, 2024, total return for the S&P 500 was roughly 1,481%. Of that, about 700% came from dividends and reinvestment, the rest from the actual price gain. In short, dividends are not a bonus, as people say. They're a fundamental building block of long-term financial investment. So why choose dividend investing? Here are the main points backed by data. Dividends give you cash you can spend, reinvest, or use for living expenses. That's especially valuable for income-focused investors. Reinvesting dividends means you buy more shares, and those additional shares pay dividends too. Over time, this snowball effect can substantially boost total return. Dividend-focused strategies also can help reduce portfolio volatility and offer a cushion during market downturns. As companies raise dividends as well, especially if they grow earnings, your income stream can keep pace or outpace inflation, helping preserve purchasing power, which we've talked about before. But not all dividend stocks are equal. We'll go more in the future on this on how to pick dividend stocks. However, there's a big difference between chasing just high-yield stocks and focusing on sustainable, growing dividend stocks. High yields can be tempting, but sometimes a red flag. A company might pay high dividends because its stock price has fallen, or because it's under major distress. A better strategy is to target dividend-growing companies, those that pay modest yields but regularly raise their payouts over time. These tend to have healthier balance sheets, lower payout ratios, and more sustainable business models. Over decades, dividend growers tend to offer better risk-adjusted returns than chasing the highest yield possible. Another major advantage is during turbulent markets or very low markets, dividends provide a cushion. Because dividends are not tied directly to short-term share price swings, they continue even if stock prices drop, cushioning your overall return. Also, companies that maintain a dividend over time often signal financial strength and disciplined management, which may translate into resilience when the market is volatile or economy slows down. Like all investing, of course, dividend investing is not risk-free. Here are some pitfalls and how to avoid them. As mentioned, a high yield can mean trouble. Always check the company's payout ratio, cash flow, debt levels, and dividend history, which we'll get more into before picking a company. Avoid chasing a high yield just because it's high. Prefer consistency and quality of a stock. Dividend payers often cluster in certain sectors, utility, consumer staples, financials, so diversify your portfolio with different dividend stocks. Dividends also may be taxed, depending on account type, qualified versus non-qualified. So consider holding dividend stocks in tax advantage accounts when possible, especially if you're not going to reinvest them and you're going to pull it out. The bottom line is to treat dividend investing like any serious investment approach. Do homework, think long-term, and focus on quality over yield. So there you have it. Whether you're seeking passive income, long-term growth, or stability through market cycles, dividend investing checks a lot of the boxes. Historically, dividends have contributed a big share of total stock returns. They provide cash flow, enable compounding, and act as a buffer when markets are very low. If you found this helpful, hit the like button, subscribe for more investment breakdowns, and let me know in the comments, do you invest for dividends, growth, or a mix of both? Until next time, this is Shinker Financial. Happy investing.